All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I'm gonna pause just a moment here until we start. I put in the feed here this morning that I'd start at about noon Eastern. We're about a minute early, so I'm just gonna delay the start here for just a moment. Then we'll go out and take a look at some of the stuff that's going on out there. There's some interesting stuff. It's a really interesting day in the market. I think more interesting than many of the other days. A lot of the other days is just like, okay, you know what? Flip a coin, 50 points either way. We're going to be pretty volatile. I think today's a little different. A little different. I'll show you why. Hope you had a great weekend. All right. All right. Well, let's get started. Good morning. Welcome back here to Trader Minute. Great to have you aboard. I want to go out today, take a look at we'll take a look at market conditions. We'll dissect IBM, General Electric, and Ford, and take a look at those three, kind of pretty boring, plain old Jane old stocks, and see what's going on there. And we'll take a look at I don't really have that much to say about the challenge. We have Adobe. In fact, let's start off with that just to get it out of the way here. We have Adobe, which is trading flat now. And it opened up. It was up about $6 on the open. It briefly splashed higher to up about 8, but very, very briefly. And then it's just kind of been bleeding back with the rest of tech. And if we look at a lot of the tech names, they're in the red. I mean, here's Amazon. It's down 3. Google, it's down 15. Facebook, it's up fractionally, but very much off its highs there. We're seeing this across tech, and Micron, which was up nicely on the open. Just seeing it across the board where the general pattern has been to sell tech here on the day. And if we look at just kind of the market breakdown of sectors here, the sector summary. Early this morning, we saw utilities and consumer staples kind of leading the way, and that's where they are now. You see energy and tech lagging here today, along with industrials, consumer discretionary, obviously being taken down by Amazon. But look at the leader. I mean, look at those financials. Financials leading the way. We have not seen that for a while, for quite some time. But we do have a jobs report, here on Friday. And, we tend to see the financials over the last several years. They've responded very positively to the jobs report. And I don't think you can say, hey, just go buy financials based on jobs report anymore. But it's one where, people kind of getting ahead of that a little bit. I think you can make that argument, but in all, we're talking about stocks that are they're just so fundamentally inexpensive, and that's today's kind of theme in the market. Investors are buying out there today. Yep, they're selling. There's some selling going on, but the things that are being bought are value. They're buying value. They're not out there chasing growth. They're not out there chasing, the high trend names, your Amazons and your Alibabas and your Microns and these ones where you just kind of have wild speculation about this, that, and the other. They're buying value. They're buying fundamental value out there. And this is kind of the first, well, not kind of, this is the first day that we have seen that. Now, we're still early in the market. We still have 4 hours to go. So a lot can still change. And in this market, I mean, we can see a 50-point difference going into the close today, right? But one of the things to note about the market today is the range on the market has been, it's been pretty hefty. It's not been light, but it has been lighter than many other days. We have not seen the same volatility, the same chop. In fact, if I put a 1-minute chart in here and we just look at today, and we come into, let's just go 1 day. Here we go. You can see that the difference in the SPY from the high to the low, right? It's nowhere near what it was yesterday in terms of the range, right? Friday. The range here, we're hitting a low right now, but the range has only been about 30 points. And that is a much tighter range than what we have, been experiencing. And you say, well, okay, that could change, and it could, right? But one of the things that tends to happen or need to happen to get investors kind of jumping back into the market is they need to see, number one, value stocks have stopped selling off. That stuff that's cheap is no longer getting thrown out, so they can have a little confidence of buying that value. And number two, they need to just see the market stabilize a little bit. Unless there's going to be some magical news or something like that, which we're not going to get in this environment, because nobody knows exactly why the market's going down. There's a myriad of reasons. So there's not going to be a one-shot bullet to take it all up. But investors will gain confidence as they see the range of the market calm down and the range of the market tone down. And, today, relatively speaking, we are seeing that range calm down, at least early on, right? We've not had the same, anywhere close to the same volatility at the open as we have on the last few days. And yes, there's still a long way to go, right? There's still, 4 hours to go here. But, that does count for a lot. That does count for something here. And is something, if you're bullish, you look at today more bullishly than you have any other day that we have seen in this slide, right? In other days we're talking about, there's bounce risk and all of that, but you're now starting to look and go, okay, maybe I'm getting closer to a little more safety type of buying where, the next dip I can kind of, settle into a little bit and be a buyer of. And I think that's what today is kind of showing here overall. We don't see a major change in the market metrics, but take a look at the bullish percent index. We've had plenty of up days in the market, right? These flash kind of rebound days in the market. Today's first day where the more bullish percent index is actually pushing on higher. Now, it needs to move up 6% to give its technical bullish signal, which it's not going to do today. But, we have seen on most even rally mornings or rally days, we've actually seen the bullish percent index move on lower. And we're seeing a little change in that, at least so far, right? Again, it's early. It's early, but we are seeing a few, key differences there. If we take a look at the number of stocks making new highs versus the number of stocks making new lows, you'll notice we're not, we're still have more stocks making new lows than new highs, but we're nowhere near some of the levels or some of the extremity that has been in this recent market. So a little bit more stabilization starting to come in. And, stabilization doesn't mean, go all in, mortgage the house. Stabilization is a process, right? And, I got a note from one of you over the weekend, and, it was very clear. It was very clear to me that, the question was, hey, where's the magic bullet for when this market is done going down? Right? That's what I want. I want this magic bullet. I want to know the exact moment it happens and what that's going to look like. Well, the reality is they all look a little different. And you look at the body of evidence. You look at the body of evidence and you go, okay, let's go take a look and, do we see it shifting? Do we see it changing? Well, so far, there's not been any period during this downward slide in the market where we have seen the body of evidence kind of changing on any given day. Where, all of a sudden we look and go, okay, now this looks a little more bullish or this looks a little more bearish. or we see the metrics really shifting. Even on some of the updates, yeah, some risk-reward scenarios come in, sure, but not where there's some metric change. Today we're seeing a little bit of that. Not enough to say, hey, you know what, the bulls are off to the races and here we go. But enough to kind of wonder and start to think, you know, do we have some of this type of action in play right here? Are we on the tail end of some of this kind of basing to where we get that bounce up here into the back up into the 200-day moving average, which would be, you know, it'd be very rare to break the 200-day moving average and not go retest it in the short term. That would be very unusual. But are we starting to get that, you know, get that enough stability here for that? And again, still early, but I think today's one of the first days where you can start to ask that question, you know, where you can start to say, hey, you know what, maybe, you know, perhaps, all right? So anyway, that's you know, that's the market here overall. Again, I have Adobe. You know, Adobe was up. I guess it's now gone red here. I'm watching the corner of my eye, down $1 here. You know, it's in that same range that it's just been futzing around in. And you know, since I've gotten into it, it has just you know, really been chopping through this range. You can kind of see the higher lows that have been coming in here, but we've also been seeing overall, you know, lower highs, at least on the closing bars for this hourly. So we have this kind of consolidation action, you know, starting to take place here in it. The bottom line, there's no real price stability in about a $7-8 range here yet. We don't see any major evidence of, hey, you know, this is, you know, fund managers are ready to, you know, take this thing and rock and roll with it. But at the same time, you know, they are willing to buy the dips on it. And so we'll see. But I'm not going anywhere with my position right here. I'll continue to hold on to it here. You know, to me, I still think the market has a substantial uptick higher, and I do expect Adobe to be a strong outperformer in that. Again, being tech, it, you know, can be a little bit different, but you know, I'm not going anywhere on that position. At the same time, I'm not looking to add too much more exposure, right? You know, I'm 50% exposed in the challenge, and, you know, I look at it and I go, okay, in this environment where there's very little price stability and I have no signals coming in, is that the environment that I want to, you know, be 100% exposed? No, it's not. You know, I mean, we have Adobe, which is moving $1,000 a day. Okay, you know what? That's enough exposure. And I got a note from one of you asking me why I don't just sell it at the highs and pick it up back at the lows. And, you know, I just kind of responded and said, you know, go for it. You know, go for it. It's one of those where, you know, you don't know that, oh, it's going to bounce off this level and then it's going to bounce off this level and bounce off this level, and, you know, who knows, does it bounce off this level, right? But in all here, it's a position that I have time with. I will look to add some more if it does break down because of the market, you know, and break down below its 200-day moving average. I don't read anything into today's candle so far or anything like that. You know, candle analysis in this, when there's zero price stability, you know, the candle analysis just doesn't have a lot of effectiveness. You look at some of the worst candles Adobe's had, you know, the next day it's gone higher, and in some cases substantially higher. So I'm not, you know, I'm not going to use that as any sort of evidence there. But let's go take a look at a few stocks out there. And, you know, this is a market where when you get a shakedown, you start to create opportunities that didn't exist before. We've talked about some of those emerging opportunities, and I think there's a few that continue to emerge. And let's start with IBM. I know this is all over the news here today. And, you know, I had mentioned that I started building a partial position. I bought 20% at 140. I bought some more on the way down here to 130. I added a little bit more here this morning. And I'm in about 65% of my position. You know, I still have plenty more to add. It's a long-term position. It's not option in terms of, hey, you know, something that's going to expire this week. This is much more long-term and something I'm comfortable holding for multiple years. And I kind of expect that I will have it for multiple years. But today they did something. They announced that they went out and purchased Red Hat. RHT is the ticker symbol. Now, Red Hat has been rumored for many, many years to be bought out. Finally, they're bought out, right? And you say, well, somebody had to know something ahead of time. Well, go look at the price action, right? Nobody knew. Maybe somebody did, but not enough somebodies to actually, move it. There's always this argument out there that, oh man, anytime a stock gets bought out, it rallies big time into it because somebody knows something. And that wasn't the case. And so what's this mean? Well, for Red Hat, nothing. Now, for Red Hat, it's going to get bought out, and all right, it's done as far as its movement. It's not really going to be tradable. You can hear analyst upgrades and downgrades, just taking it to its buyout price. There is some talk that maybe somebody comes in and outbids IBM, but IBM put a pretty hefty bid out there. And they absolutely overpaid here in terms of from the market's perspective. The way the market looks at this, they absolutely overpaid. And that's why Red Hat is up and IBM is down, because investors fear that they overpaid here for the company. But what has been IBM's problem, right? What has been IBM's issue? Why have they been struggling here of late? Well, let's go into Y charts, and we'll just take a look at some of the fundamentals here with IBM, and we can see why they've been struggling. Okay, and let's just come into financial metric. Let's come into revenue over the last 10 years, and look at their revenue trend, right? Their revenue trend has been awful. It has been abysmal. It's down 20% since 2012. I mean, what's the economy done, right? I mean, what's the global economy done during that time? And IBM's revenues have just continued to drop. Now, one of the reasons why I've been interested in being a net IBM buyer here is because the revenues are slowing in terms of their drop, right? The revenues, in fact, if we come and put a real-time model here on it, you could see the revenues have dropped, but that hard drop is stopped. It's come into this basing pattern, right? And now investors have just gotten that typical kind of, all right, it's never going to rise again, right? Why did they buy Red Hat, right? Well, when you look at revenue on Red Hat, and let's come in here to RHT. There we go. And we come in and put revenues here on Red Hat. Look at that revenue growth. Man, it's just been a monster trajectory of revenue growth. I mean, they've gone from $1 billion back in 2012 up to $3 billion. I mean, they've grown 200% there. This is something where it's going to add instant revenue growth to IBM's bottom line, and that's been one of their biggest problems. And if you listen to kind of some of the words and some of the things that were said, they're looking to buy growth. And this is not necessarily their last transaction. And they're out there, they're looking to buy growth. They haven't been able to do it internally for a variety of reasons. So now they're saying, look, we have cash, right? So we are going to go and, we are going to go and buy, we're going to go and buy our growth. Now, how's this different from, other companies that, have gone and bought their own stock and, have kind of, had some growth with that, right? But if you come and look at the cash here for IBM, their cash has been significantly on the rise, right? So while their revenues have been going down, their cash has been on the rise, and now they're looking to use this by, growing the company. Not massive share buyback, not special dividends, but to really grow the company. I think longer term, that has to make you a lot more bullish here overall on IBM. Now, why doesn't it go up on a day like today? Right? Why wouldn't investors step in and buy it aggressively if they're going to be adding revenue, going to be adding earnings to their bottom line? And they have the cash to do it. It's not like, yes, it's an expensive deal, and yes, they're going to have to do some things, but overall, it's not going to put IBM under. So why wouldn't investors buy it? Well, the commentary just of, hey, we're looking to buy more, right? Investors don't want to wake up tomorrow and go, oh, IBM just bought somebody else and they overpaid. And they bought somebody else and overpaid. And they bought somebody else and overpaid, right? And be just sitting there as the stock ticks on lower as they continue to overpay, right? Because the market almost always sees these deals as if, they overpaid. And so are investors going to be super eager in the ultra short term to jump in and dive feet first here into the water? No. They're gonna dip their toes. They're gonna nibble. But to say, hey, let's go put some massive money right here, right now, and all aboard, they're not going to be willing to do that until they start to see some of the estimates start to creep up. And I think that's what, if you're looking to trade IBM short term, that's what you want to start to look for. You want to start to look for the estimates to tick up. Those mornings where you wake up and, JP Morgan comes out. They raise their estimates on IBM. I'm not saying they upgrade it to a buy or they raise their price target or anything nominal like that. I'm talking about analysts increasing their revenue and earnings estimates for IBM based on these acquisitions. And it doesn't happen right away. It doesn't happen instantly. It can take months in some cases. I mean, we saw Disney, right? And everything they went through and the merger stuff and everything else. But overall, when did they start to go up? Yeah, during some of the Fox stuff, but as those earnings estimates started to tick up because of the merger acquisition type of activity. And so when it comes to IBM, that's what they're going to need in terms of some of the short term. Like if you wake up one morning and you see a note from an analyst raising their revenue and earnings estimates on IBM, you probably have a 3-day rally in it. And that's something I'll be looking for, as well. But, what keeps people out in the ultra short term is that fear that they're going to step in and buy somebody else. Because IBM definitely has the power to do it. And, definitely has shown they're willing to pay more than what the market believes they have to. Now, does IBM think they overpaid? No, probably not. But, is this an act of desperation by IBM management? Well, there's an argument for that, right? There's always, multiple arguments, but over time, this is something that's going to add nicely to their bottom line, and give them a growth component that has been sorely lacking, and they just haven't been able to generate, here on their own, at least over the last 5 years here. Okay, all right, so that's IBM. General Electric. Was asked about General Electric, take a closer look at it. This is a stock that, to me, is absolutely in a basing process. But, this is one that at the beginning of the year I looked at, and if you look at it from a, dogs of the Dow type of perspective, it was one that was very, very interesting. And I got involved in it. I'm not as deep in it as I was. I've had to trim out here over time. Fortunately, I was able to add on a few spots, and I'll be able to take away so I don't have a big loss. But this is one that just, the story here with General Electric just continues to decline. And I think if you're looking for the absolute all clear signal for General Electric, you have to wait for that JP Morgan analyst to change his tune. The reality is sometimes when it comes to stocks, and this isn't most cases, I could care less about analyst commentary, right? Because they've been wrong and now they're changing their tune. But there are some situations that come into play where an analyst is just right and has been, continues to be, and every time they speak, they're even more right. And this JP Morgan analyst, that's what he's been. Right here. on this, after this rally right here where the stock pushed above 14. The next morning he came out and said, no, you don't get ahead of yourselves. This thing could go to single digits possibly, right? There's just been a general downturn. So if you're looking for an all clear, I wouldn't go to the chart. I wouldn't look at fundamentals. I'd just look at that J.P. Morgan analyst, and when they say, hey, you know what, everything's clear, it's gonna skyrocket. Now, he's not going to come out and say everything's clear. He's not going to come out and say, oh, bottom's in, now turn into be buyers. Rarely do we see that from analysts. But we start to hear their tone shift. We start to see them shift from a big bad bear to, there's actually a little bit of a bullish case coming in here, and start to kind of just slowly shift their tune. And we have seen GE upgraded by several other analysts here over the last 2 months. And it is something where ultimately they could be right. But there's just something the stock is still lacking. And that is a higher low. Yep, they've had rallies. There's been some big volume rallies, but just a higher low. All the lows have been lower lows. And we continue to see that. We've had divergences in the indicator, but the lows continue to be lower. And you look at this market, and you look at a market that is, as nervous as this one is, right? As nervous as this one is, and they're willing to buy valuation, right? You start to look and say, well, what about valuation here for General Electric, right? Is there a value here? I mean, their revenues have steadily been increasing, right? I mean, they've been growing their revenues here a little bit. Now that's not going to continue as they've sold some assets, and those revenue numbers are going to come down. But they have sold some of that. But at some point, do we start getting into book value here? I mean, the price to book value, it's 1.8. So you say, well, no, that's not exactly dirt cheap. I can go get Ford at 1, right? I can go get Bank of America cheaper, right? I could go get a lot of companies at a price to book that is cheaper. And unfortunately, they've hurt some of their book value with some of their asset sales. But they continue to do that. We've had one CEO turnaround story come in, and, they now have to leave. And it just continues to be a headache. And you look and you say, from an investor standpoint, do you want to own Honeywell, Boeing, or do you want to buy General Electric? And I can't find a fundamental reason why you would say, hey, I'd rather own General Electric. I mean, their dividend's 4.2%. That's a good dividend. But when you look at it comparatively and you put something like a Ford on there, Ford's dividend's 6.5%. I mean, 6.5%. That's, 2 full percentage points, plus you have a cheaper stock. And so General Electric, it will bottom. It will ultimately bottom, and it will probably be okay. But at the same time, some of the turnaround stuff that they needed to do just hasn't been done. We haven't seen any real evidence of significant improvement in the business. And, they're not exactly in an IBM position where they can go out and buy growth, right? They're still in the cut mode. And as long as they're in that cut mode, it's one where there's just probably some better options from an investment standpoint. Now, can you ride out GE right here? I do think you can. I do think GE can be ridden out here, and it can be, something where you can expect that, it might dip to 8, but it'll be back to 12 at some point, going forward. It just isn't going to happen anytime soon, barring some sort of massive news. I mean, their market cap is down to $100 billion. And it's almost just one of these where, if their market cap gets another $20 billion, down another $20 billion, I mean, do you actually see it as a buyout candidate? Do you actually see that somebody comes in and buys them, or some sort of? I mean, I know that's ludicrous to say, but that's how cheap they're getting. I mean, that is just how cheap they're getting in terms of market cap. Now, you look at the book value per share; it's still too high. They do have cash on hand. That's not an issue. I don't think their dividend is in danger of getting cut or anything like that. But they report earnings here in the morning. And to me, it's just going to be a very interesting report in terms of what they have to say. I do think the bar is low, meaning they don't have to say a lot to be very positive. But I don't know that the reaction really kind of tells the whole story. Been waiting for a kitchen sink earnings for General Electric. We just haven't seen it. Where they just kitchen sink everything, where they say, look, yes, this is an issue, this is an issue, this is bad, we're writing this off, this. We are terrible, we project no growth, we project no real earnings. That they do a Walmart. Walmart kitchen sinked it. Back in 2016, Walmart finally kitchen sinked it. They finally said, you know what? Yes, we suck. We have to make major changes. And it was this earnings report, and the stock dropped like a rock on it. Just dropped like a rock and said, you know what? We don't expect any revenue growth going forward. We don't expect any earnings growth. We just have a lot of stuff that we need to get together. But we're going to do it. And the stock, boom. And we even talked about it. I mean, you can go check out the videos from back here. They kitchen sinked it. That's a bottom. That's a massive bottom, long-term bottom in the stock. And we see what's happened over time since, right? It's had ups and downs and all arounds. But in terms of, a major long-term bottom, that's what we saw. So for General Electric, for me, that's what I want to see. If I'm going to go and say, you know what, major long-term bottom in play here, the way I think it is for something like an AT&T, the way, it was for Walmart back then, the way we'll talk about some housing stocks, here this week. I want to see them kitchen sink it. I wouldn't mind to see the stock trade under 10 after they kitchen sink it. I think ultimately those would be some very buyable opportunities. Now, last but not least, Ford. And I've already mentioned Ford a little bit here. But I went and bought a kind of an all-or-nothing position here on Ford back here, around 9, that would kind of bounce off this level. And it took another dip, and, it's one of those where, okay, great, put what I was willing to risk. I didn't have to back out of it. It just could let it expire. But, if you remember talking back here, this is a company that is just absolutely dirt cheap at 9, and anything below 9 is a gift. This morning, Goldman Sachs came out, upgraded Ford to a buy, put a $12 price target on it. $12 price target. I mean, that's 30% higher. In an environment where tariffs are rising, in an environment where, auto sales are declining. But the one thing about Ford is that fundamentally, it is an absolute value play. It's an absolute value play. And this doesn't mean it's going to go up every day and all of that. But even where it is right now, it's an absolute value play. You can hold Ford shares for a 6.5% dividend. And you say, well, what does that matter when the stock's moving $1 every 2 months, right? Well, that still gives you about 50 cents of cushion there, right? So, you have a 6.5% dividend. Even after today's bounce, it's 6.5%. It was 6.8% last week, right? You have a company who, when you look at what they're doing out there and what's going on revenue-wise, their revenues are climbing. This isn't an IBM story where the stock's been dropping as their revenues have been falling. Their stock's been dropping as their revenues have been climbing. There's just fears that their revenues are going to, not continue to climb, but they have kind of proven those wrong. That was one of the reasons why we saw the earnings bounce with Ford. In fact, if we come in and look at sales, let's see if I can pull it up here. Revenue estimates for, current fiscal year. All right. You see, well, here's some of the estimates. That number's not coming in correctly for them, so I'm not gonna look at that. But but overall, some of the revenue estimates are on the rise a little bit. Nothing major. We saw that news out of China last night, where China is proposing to cut their auto sales tax in half. What are they responding to? Well, they're responding to the first drop in auto sales, year-over-year drop in auto sales in like 20 years. Ford isn't a huge part of the Chinese market, but definitely a benefit for Ford there, especially if the auto market in China starts to heat back up a little bit. Tariffs be damned. But when you look at Ford and you look at where the earnings are, where the revenue is, here's the earnings. The earnings have been steady and flat, right? They haven't been going up all that. They haven't been dropping all that, right? As the stock has been pulling on back. But with Ford, you're just talking about an absolute value play right here in a way that you just don't have with General Electric. Right, you just don't have there, and one where, if we're sitting here next year and Ford's trading at 9, something really bad has had to happen. Meaning, we have to be in a strong, global recession, strong bear market, something out of the ordinary happened to the markets that dropped the markets by 80% or something like that, some mechanic or something of that nature, or some sort of massive scandal in Ford where they had to rewrite their books, or they had to come out and fire a bunch of people because of fraud and all of that, right? It has to be something massive, and those things could happen, right? But when you just look at a company with growing revenue, flat earnings, trading at book value pretty much, if we look at the price to book here on it, it's trading at 1 times book, just over 1 times book. It's just with a 6.5% dividend. It wasn't this cheap, it wasn't this compelling, a few months ago. It was still a long-term compelling type of an argument, and it's one of those that's just gotten a little bit better here as some of this fear has come in. So when we look and go, okay, where do we see some dislodging when it comes to some of the market mechanics that we have seen here of late? I think when it comes to an IBM, when it comes to a Ford, we've seen it. With a General Electric, I don't think it's been the market that's created that dislodging. I think that's been its own story more than anything, and something that it still has to kind of tell its own story and kind of march to the beat of its own drum and do its own things. Here for investors to really step in a massive way, and we can see it. Ideally they'll kitchen sink it tomorrow, but anyway. Okay, we have many more earnings up and coming here. I put some of the analyst comments ahead of earnings on Apple into the message feed this morning, and it's one where you look at Apple, you compare it to the rest of the tech world. I know, yes, little head and shoulders leading down, and if Apple gaps down on earnings, there's going to be technical textbooks written that say, "Oh, see, look at that pattern. That's just a massive bearish pattern." And if it gaps down on earnings, all the textbooks are going to show that pattern, right? If it gaps up, they're not going to show that pattern. They're going to say, "Look at the trend. Technical analysis rule number 101: trade the trend." Right? It'll just tell the opposite story. But this is something where analysts are fairly high on the stock going into earnings. This has been a company that, yes, has pulled back in October, but it's also a company that has some interesting seasonality. And there are a lot of stocks that are starting to head into a period of really good seasonality, really bullish seasonality, right? Here into November, December. But when you take a look at some of these tech names, right? Even something like I have Adobe here. October has been generally its most bullish month. Hasn't been this year. I think the stock is down 12% in October, this October. November and December, January have kind of been its flat, nobody cares months. When it comes to Adobe, Apple's kind of similar here. Now, you come back Apple 20 years. October's a huge month. October's a huge month. What's Apple done, this October? Well, it's down. Obviously, it's the market. November's been decent. In fact, it's been one of its biggest gainer months, but it hasn't been, hey, every November it's up. December overall has been one of its worst months. Only September has been worse for Apple. So, Apple's starting to go into a little bit of seasonal weakness. I don't really think it matters all that much because of where October is. And some of these stocks that are a little seasonally weak in November and December that have pulled back aggressively this October when they tend to be pretty solid in October, I think we could be looking at a pretty interesting switch of the trend. And I do think some of that's going to come down to Apple's earnings. And I don't even know if it comes down to what their numbers are. I think it may just come down to how investors process iPhone sales. When it comes to Apple, for years and years, it's all about iPhone sales. Do they sell enough iPhones? What's the iPhone sales numbers? Are they growing the iPhone sales numbers? And iPhone sales this and iPhone sales that. But what's been going on is they've been turning into a massive cash cow with iTunes, right? And that's been overlooked on some of their earnings gap down and some of the stuff that they've gone through. But last earnings, we saw a shift. Investors actually said, "Oh wow, yeah, they're printing money. They're absolutely printing money." And okay, yeah, iPhone sales are down a little bit. Okay, they're still printing money, and I do think that we will see an even more positive iTunes story, but I think the iPhone story could be fairly flat. And I think the reaction is going to be, for a lot of stocks, I don't think the reaction to the earnings says much about earnings or how investors are going to react going forward. But with Apple, I think it'll be a little bit different. With Apple, I think if there's a positive reaction, I think that's going to lead to a lot more money over time, even into the end of the year on Apple. And, I think it would represent a little bit of a perception shift going on with the company that is sorely needed. Because when you look at Apple and you go and you say, well, fundamentally, where is it at, right? I mean, yes, its price to book value is all-time high, but this has been nothing. The stock has never traded on, on book value in a major way here. Right, they trade on revenue historically, and you can see revenues are at an all-time high. Oh, and so is the stock. And so if their revenues continue to grow, whether it be iPhone or iTunes, I think that's what the market's going to want to see. And if they're able to get that, then I think they'll be in a good spot. But this isn't a dividend name. It's trading at a 1% dividend. You don't trade this for dividends or own it for dividends. They continue to grow their earnings per share. They're up to 11. I mean, it's just been a monster story. You remember back here in 2010, 2011, people talking, man, Apple's grown so much, they can't continue to grow like this. Well, they have. They absolutely have, and they continue to have stuff in the pipeline, to grow. And it's not a cheap value story, but at the same time, you're not looking at a massively expensive company either. So I think the reaction is actually going to be very important when it comes to Apple, much more important than it is with most other stocks, right? Than it is with most other stocks where you look at them and you go, okay, FCX, here's the reaction. Well, what does that mean about the earnings? Well, not a hill of beans. It doesn't say anything about it. Here's CAT. What's it say about the earnings? The reaction is sharply negative. What's that say about the earnings? I don't think it says a heck of a whole lot. I think it says something about the investor perception or fears, but in all, it's something where, yes, gap down, but the earnings story actually, in my opinion, increased. Doesn't mean you go buy it just because of that, but when you look and you say, what do I expect during the course of the quarter? And you say, hey, you know what, a rebound to 130 after it bases out, maybe drifts even a little bit lower, 130 is not exactly a hard argument to make based on, some of those earning fundamentals. Okay? So anyway, hopefully that gives a little bit of perspective there. Now I mentioned for the challenge I have Adobe, and I'm looking for some Katie signals to come in to add more exposure, which just hasn't happened. We have a little bit of 3-7 crossover action going on today. One of them is American Airlines that has some 3-7 action on it. I don't know if it'll qualify as a Katie signal yet. We have Under Armour with a 3-7 action on it. Now he has earnings here, I believe either after the bell today or tomorrow. So, not exactly tradable there for me for the challenge. You look at something like a Wells Fargo, has the 3-7 action on it here today. I'm not sure what the consolidation risk will look like. Bank of America, still quite a ways from a 3-7 crossover. JP Morgan, quite a ways from a 3-7 crossover still, even though they're having, fantastic days here today. But I think that just kind of goes to my argument that I made at the beginning here, that today's a mildly more bullish day than a lot of the others have been for the overall market, and it's because value is getting bought. We are seeing value get bought. We're seeing, a little bit more relative stability. Lennar in the housing space, 3-7 crossover here. This is a space that I absolutely think is bottomed. And I know it's just bad news. In fact, with one of you, I said, asking me about some investment stuff, and I said, well, go check out the housing sector. And, came back to me and said, well, they got this problem and this problem and this problem and this problem. And yep, they do. They have a million problems. It's all problems in the housing space. Is it priced in already? I think that's the thing that has to be asked. Are all the problems priced in already? I mean, everything was great for Micron. Great, grand, wonderful. Micron's going to 100. Chips are going to be in high supply, low supply, high demand forever. It's going to be great, grand, wonderful. Is all the good news priced in? I think when we talked about housing right now, I think we were talking about one of those scenarios where it's one of the better compelling arguments that bad news is all priced in. I don't think you can say that about a lot of things, but I think you can say that about housing right here. Here's Ulta Beauty with a 3-7 crossover here. Dollar Tree with a 3-7 crossover. Target with a 3-7 crossover. So we're seeing some of these come in. Zion Bank with a 3-7 crossover. General Mills with a 3-7 crossover. Hanes Brand with a 3-7 crossover here today. Goodyear Tire. You can see some of the different sectors, right? This isn't just, one sector. Here's INSEE in the pharma space with a 3-7 crossover. ESRX has a 3-7 crossover. Estee Lauder 3-7 crossover. Genuine Auto Parts here with a 3-7 crossover. Dover and Industrial with a 3-7 crossover. You probably, kind of get the point here. In fact, on the S&P, there's about 10% of the S&P with a 3-7 crossover on it today. It's a massive, massive number. And, we're not seeing a lot of tech names or anything like that in it. But, it's one where there's quite a bit of consumer discretionary. And I know consumer discretionary is down today because of Amazon, but the Under Armour's, Lennar's, Targets, Dollar Tree, Ulta, those names here. There's a couple consumer staples, but not a ton there. There's quite a few financials, not your big major banks, but your U.S. Bank Corp, your Wells Fargo, like we mentioned, your BB&T. In there, and then a few industrials sprinkled in. It's just a list that is relatively diverse, that is not sector heavy one way or the other, and is something we just haven't seen. We just haven't seen. And if you're bullish, it's something you look at and say, "Oh, good, all right, maybe." And so I do think it'll be worth looking at, worth analyzing as we go into the close, and as this market week kind of transpires. I know I don't have a crystal ball, and I can't. Things can always happen, and there's news and all that kind of stuff. But this is just a market right now that path of least resistance is not lower; it's higher. And last week we talked about the market and path of least resistance being lower. right now, path of least resistance is in this market is absolutely higher in the short run, and it is something where we get up to this 200, we get up to 276 or 278 on the S&P. There'll be a strong dip down. We'll have a couple more fear days that will come into this market, right? This isn't one where you can just expect the market to pull something like this and go from June, July, August, September. I think this is something where we're going to have something kind of like this transpire, but I think the path of least resistance here overall is to the upside. Options are not that expensive for quite a few things. So if you're looking to add some exposure, I think this is a better spot than some of those spots that we've had. And we'll address it a little bit more. But if you say if all your trading is just the challenge, then you're probably not going to see me add much more exposure, right? I'll run with my Adobe and go. But if you're looking at saying, hey, I want to add more exposure, there's some interesting stuff out there today, and we've touched on a lot of it. And it sets up some decent risk reward elements here with them as well. But the one thing to keep in mind is that as we look at some of these, and as some of these stocks make some of these moves, American Airlines, right? It's one of those where I'm a little more interested in seeing some of the bull signals that come in and then buying them on their first dips. Because a lot of times that's what we'll see. We'll see fund managers step in. We'll see traders step in. They'll stretch it a little, and then the market element will crush it a little bit. And then those tend to be some pretty nice buys off those higher lows with those KD signals. And I would not be surprised to see some of that come in. And, as it does, we will look at it, and we will definitely look to trade it. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.